Physical, $95. Paper, $79. The two-tier pricing commences. London Vaults can't deliver. Physical, $95. Paper, $79. The two-tier pricing commences. London Vaults can't deliver. For the first time in modern financial history, the same ounce of gold is trading at two different prices. One price, if you want paper promises. Another price, if you demand the metal in your hand. $16 apart. The vaults that have anchored global metal markets for over a century are now turning away delivery requests. Major institutions are quietly discovering their gold certificates may not be backed by actual gold. This isn't a temporary shortage. This is a structural fracture in the foundation of commodity markets. And what's happening in London right now could trigger a cascade that reaches every Treasury department, every central bank, every business balance sheet holding precious metal exposure. The question is no longer if this system breaks, but who will be left holding worthless paper? When it does, welcome to financial inspection. If you've spent decades building your understanding of how markets truly function, if you remember when a handshake meant something and financial statements told the truth, then you're in the right place. We don't chase headlines here. We examine the structural cracks before they become catastrophes. Now, if you'd appreciate this kind of sober analysis landing in your feed regularly, the way you used to receive your morning financial paper, go ahead and click that subscribe button just below this video. And do us a favor, drop a comment telling us where in the world are you watching this from? Are you monitoring these developments from New York, London, Singapore, or perhaps from a quieter corner of the world where you've wisely positioned yourself? We'd genuinely like to know who's paying attention to what's unfolding. Now, let's examine exactly what this price divergence means and why it matters far more than most realize. A financial analyst sat at his desk in Frankfurt last Tuesday morning, staring at two numbers that should have been identical. Physical gold, $95 per ounce. Paper gold, $79 per ounce. The same metal, two different prices, separated by a $16 chasm that, according to every textbook he had studied, should not exist. He refreshed his screen 3 times. The numbers remained unchanged. For over 40 years, the global precious metals market has operated on a fundamental principle. 1 ounce of gold trades at one price, whether that ounce sits in a vault or exists as a contract on paper. Arbitrage traders have always ensured this alignment. When physical metal costs more, they sell physical and buy paper. When paper costs more, they do the opposite. This mechanism has kept prices synchronized across continents and instruments since the modern bullion market took shape. Until now. The $16 gap represents something far more significant than a temporary supply bottleneck. It signals a breakdown in the very architecture of how precious metals are priced, traded, and settled worldwide. To understand the magnitude of this development, one must first grasp the distinction between physical and paper metal. Physical metal means actual bars or coins sitting in a vault, fully owned and allocated to a specific holder. When someone buys physical gold, they receive metal they can touch, store, and transport. No counterparty risk exists beyond the physical security of the storage facility itself. Paper metal encompasses a broader universe of instruments: futures contracts, exchange-traded funds, unallocated vault accounts, and various derivatives. These instruments promise exposure to gold or silver prices without requiring the holder to take physical possession. A pension fund manager in Chicago can gain gold exposure by purchasing shares in a gold ETF. A corporation can hedge currency risk using gold futures. For decades, this system has functioned smoothly, with participants treating paper claims as equivalent to physical metal. The COMEX Futures Exchange in New York and the London bullion market have served as the primary price-setting mechanisms for global precious metals. Hundreds of billions in notional value trade daily across these platforms. Prices discovered in these paper markets have traditionally governed what physical metal costs at refineries, coin dealers, and jewelry manufacturers worldwide. This unified pricing structure depends entirely on confidence in delivery. When a futures contract expires, the holder should be able to demand physical settlement. When an ETF investor wants to redeem shares for actual metal, the fund should produce the bars. When an unallocated account holder in London requests conversion to allocated storage, the vault should deliver the specified ounces. These delivery mechanisms serve as the critical link ensuring paper prices track physical reality. And that link is now breaking. Reports have emerged from multiple sources over the past 3 weeks, documenting delivery delays and outright refusals at major London vaults. Institutional holders requesting conversion from unallocated to allocated accounts are being told to wait. Some are being offered cash settlement at paper prices instead of metal delivery. Others are experiencing processing delays that stretch from the standard 48 hours to multiple weeks. The London Bullion Market Association system operates as the deepest pool of wholesale metal liquidity in the world. When London struggles to deliver, the implications extend far beyond one city's vaults. Historically, price divergences have occurred during extreme crisis moments. In 1980, during the Hunt brothers silver manipulation, brief premiums appeared for physical delivery. In 2008, following the Lehman collapse, gold coins temporarily commanded premiums over spot prices as investors fled to tangible assets. In March 2020, pandemic-related logistics disruptions created short-term delivery bottlenecks. Each previous instance resolved within weeks as normal market function restored arbitrage opportunities. The current divergence exhibits different characteristics. It has persisted for 3 consecutive weeks. It has widened rather than narrowed. And most significantly, it coincides with delivery refusals rather than mere logistical delays. Market participants are beginning to ask an uncomfortable question. How many claims exist for each physical ounce actually sitting in vaults? The fractional reserve nature of the unallocated account system has never been secret. Banks have always held less physical metal than the total claims against their vaults. This practice works smoothly as long as redemption requests remain modest and predictable. But when confidence erodes, when multiple holders simultaneously demand physical settlement, the mathematics become impossible, and the $16 gap suggests that confidence is eroding right now. A senior bullion banker in London received an unusual phone call 3 weeks ago. The caller represented a Middle Eastern sovereign wealth fund managing over $200 billion in assets. The request was simple. Convert $40 million in unallocated gold holdings to allocated bars. Physical delivery preferred within standard settlement timeframes. The banker hesitated before responding. We can offer you cash settlement at current spot price, he said carefully, or allocated conversion with an 8-week timeline. 8 weeks for a transaction that should take 48 hours. The sovereign fund manager hung up and immediately called his counterpart at a competitor vault. Same request, similar response. He made 4 more calls that afternoon. The story remained consistent across London's major bullion banks. The system was stalling. To understand why this matters, one must examine how the London bullion market actually functions beneath its polished surface. The London system operates on a structure most market participants never see. At its core sits the unallocated account model, a mechanism that has facilitated efficient metal trading for generations while quietly building leverage into the foundation of global precious metals markets. When institutions deposit gold into an unallocated account, they do not own specific bars. Instead, they hold a claim against the bank's general metal inventory. The bank records the quantity owed but does not segregate particular bars for that client. This arrangement offers flexibility and lower storage costs. Transactions between unallocated accounts happen instantly through ledger entries without physically moving metal. The efficiency is remarkable. The risk is hidden. Banks holding unallocated deposits do not maintain 100% backing. They operate more like traditional banks accepting cash deposits, holding fractional reserves while lending or leasing the majority of metal to other market participants. A bank might hold claims totaling 1,000 ounces against only 300 ounces of physical inventory. This works perfectly under normal conditions. Most account holders never request physical delivery simultaneously. The bank can manage redemptions from existing inventory while purchasing additional metal as needed from the market. But the model contains a fatal assumption that metal will always be available for purchase when needed. That assumption is now being tested. Industry analysts examining available data have noticed troubling patterns. London Vault inventories, where disclosed, have declined 17% over the past 14 months. Meanwhile, redemption requests documented through LBMA settlement statistics have increased 42% during the same period. The mathematics point toward a narrowing buffer. Compounding this pressure, central banks across multiple continents have quietly shifted their metal management strategies over the past decade. Austria repatriated portions of its gold reserves from London in 2015. Germany completed a multi-year repatriation program in 2017, bringing 300 tons home from foreign vaults. The Netherlands, Belgium, and Poland have executed similar moves. These actions were officially explained as prudent risk management and political symbolism, but they produced a concrete effect, reducing the pool of metal available within the London system. Simultaneously, Asian demand patterns have evolved. Chinese and Indian buyers, traditionally comfortable with paper exposure through futures and ETFs, have demonstrated increasing preference for physical settlement. Shanghai Gold Exchange delivery volumes have surged, while COMEX registered inventory has declined to levels not seen since 2016. The directional flow is clear. Metal is moving from west to east, from paper claims to physical possession, from pooled storage to segregated allocation. This migration creates mechanical stress on London's fractional system. Adding further pressure, the operational costs of managing physical metal have escalated dramatically. Energy prices affecting refining operations have doubled in some regions since 2021. Insurance premiums for vault facilities have increased 30 to 50% as geopolitical risks multiply. Security costs have risen alongside global instability. Transportation presents its own challenges. Moving metal between London, New York, and Zurich now involves more complex logistics than a decade ago. Regulatory requirements for cross-border metal movements have tightened. Lead times have extended. What once took 3 days now requires 2 weeks, even under optimal conditions. Meanwhile, regulatory changes are quietly reshaping settlement requirements. Basel III banking standards, implemented in phases across different jurisdictions, now treat unallocated metal differently than allocated holdings for capital adequacy purposes. Banks face higher capital charges for maintaining large unallocated positions. This regulatory shift incentivizes banks to reduce their willingness to hold fractional reserves in metal. All these pressures, repatriation flows, Asian physical demand, operational cost increases, and regulatory changes, are converging simultaneously on a system built for a different era. The $16 premium is not the cause of these problems. It is the symptom. It represents the market's first honest price signal that something fundamental has shifted. Physical metal is being revalued upward relative to paper claims, because delivery certainty now carries a premium. And when delivery certainty commands a premium, confidence in the paper system is eroding in real time. A risk management committee convened in a glass-walled conference room overlooking Manhattan last Thursday. 12 executives sat around the table. The chief financial officer had called the emergency meeting after discovering something in their quarterly audit that no one had anticipated. Their company held $73 million in gold ETF shares as part of their treasury diversification strategy. Standard practice, conservative allocation, approved by the board 18 months ago. But the CFO had asked a question that morning no one had thought to ask before. If we liquidate this position today, do we receive $73 million in cash, or do we receive actual metal? The corporate treasurer checked the fund prospectus. Page 47 contained the answer buried in legal language. The fund reserves the right to settle redemptions in cash at the trustee's discretion during periods of market stress. Cash settlement, at paper prices, during the exact moments when metal might be needed most. The executives looked at each other across the mahogany table. Their gold exposure might not be gold exposure at all. They were not alone in this realization. Across the global financial system, precious metals serve functions far beyond simple investment holdings. They operate as collateral in complex lending arrangements. Banks accept gold as security against credit lines. Trading firms pledge metal holdings to access leverage in derivative markets. Clearinghouses require metal deposits to manage counterparty risk in futures trading. This entire collateral infrastructure depends on one assumption: that metal holdings can be valued reliably and converted to cash or physical delivery when necessary. The two-tier pricing destroys that assumption. Consider a European bank that has accepted $10 million in gold ETF shares as collateral for a corporate loan. The bank's risk models value that collateral at current market prices. But if the borrower defaults and the bank must liquidate the collateral, which price applies? The paper price of $79 or the physical price of $95? If the bank can only access paper settlement, the collateral is worth 20% less than the loan documentation assumes. Multiply this scenario across thousands of lending arrangements, and the scope of potential repricing becomes clear. Derivative exposure presents an even more complex web of interconnected risk. Gold and silver derivatives underpin a multi-trillion-dollar market of options, swaps, and structured products. Commodity trading advisors run systematic strategies across metal futures. Hedge funds maintain basis trades, exploiting small price differentials between contracts. Mining companies hedge future production using forward sales. All of these positions assume liquid markets and reliable delivery mechanisms. When delivery fails, the mathematical models underpinning these strategies become invalid. A basis trade expecting convergence between physical and paper prices loses money when divergence widens instead. A mining company's hedge becomes worthless if the counterparty cannot deliver cash or metal at contract expiration. The counterparty risk question becomes critical. Who holds the liability when a vault cannot deliver metal to satisfy a derivative contract? Financial history provides sobering examples of how commodity delivery failures cascade through interconnected markets. In the nickel market collapse of 2022, the London Metal Exchange faced delivery defaults that threatened the solvency of major trading firms. The exchange responded by canceling trades and suspending the nickel contract entirely. Billions in losses materialized overnight. Lawsuits continue years later. Precious metals markets are significantly larger, more globally distributed, and more deeply embedded in financial system infrastructure than nickel trading. A delivery crisis in gold or silver carries correspondingly larger systemic implications. For industries dependent on physical metal procurement, the two-tier pricing creates immediate operational challenges. Electronics manufacturers require silver for circuit boards and contacts. Jewelry fabricators need gold for production schedules planned months in advance. Aerospace companies use platinum group metals in specialized applications. These businesses have historically managed metal costs through futures hedging. They lock in prices months ahead using paper contracts, then take physical delivery when needed for production. But what happens when paper hedges settle at $79 while physical metal costs $95 at delivery time? The hedge fails. Input costs spike, profit margins evaporate. Supply chain managers are now discovering that their risk management strategies contain a hidden vulnerability they never modeled. Corporate treasury departments face similar challenges with currency hedging. Many international businesses use gold as a hedge against currency volatility. A European company with dollar revenues might hold gold exposure to offset euro weakness. This strategy assumes gold can be liquidated quickly at transparent prices when currency hedges need adjustment. Two-tier pricing introduces basis risk that treasury models never contemplated. The gold position might be worth different amounts, depending on whether settlement occurs in paper or physical form. Beyond corporate balance sheets, the implications extend into monetary system architecture itself. Central banks hold approximately 35,000 tons of gold in official reserves. These holdings serve as the ultimate backstop for currency stability in crisis scenarios. The implicit understanding across the global financial system is that central bank gold represents reliable, deliverable value. But central banks hold metal in various forms. Some maintain physical bars in domestic vaults. Others hold allocated accounts in London or New York. Still others hold unallocated claims or participate in gold lending programs. If the London vault system cannot deliver on private institutional requests, can it deliver on central bank claims during a genuine monetary crisis? The question matters because gold's role in reserve management depends entirely on delivery certainty. A central bank needs to know that its gold reserves can be mobilized when needed, whether for currency intervention, debt service, or maintaining confidence during financial instability. Paper claims that cannot convert to physical metal are not reserves. They are counterparty credit exposure. Pension funds and insurance companies managing long-term liabilities have discovered similar concerns. Many hold metal exposure through ETFs or futures as portfolio diversifiers. Their actuarial models and risk frameworks assume these holdings can be liquidated at quoted market prices. The assumption is being challenged in real time. Fund managers are now auditing their metal holdings, examining the fine print in prospectuses, and asking trustees uncomfortable questions about physical delivery capabilities. Some are discovering their safe haven allocations contain structural risks never disclosed to beneficiaries. The two-tier pricing is forcing a fundamental reassessment across every level of the financial system. What appeared to be liquid, transparent, and reliable metal exposure is revealing itself as a complex web of claims, dependencies, and counterparty obligations that function only under conditions of sustained confidence. And confidence, once broken, is extraordinarily difficult to restore. A Fortune 500 treasurer closed his office door Monday morning and opened a spreadsheet he had been avoiding for 3 days. Column A listed every precious metal position held across the company's global operations. Column B showed whether each position represented physical metal or paper claims. Column C remained empty, waiting for his assessment of actual deliverable value. He had spent 15 years in corporate treasury. He had managed currency crises, navigated credit crunches, and restructured debt during the 2008 collapse. But he had never questioned whether his gold holdings were actually gold. Now he was questioning everything. His first call went to the company's primary bullion bank. Simple question. If we request physical delivery of our unallocated holdings today, what timeline are we looking at? The answer came after a long pause. We would need to discuss that with our metals desk and get back to you. That non-answer told him everything. He began filling in column C with a new category he had just created, delivery risk, high. Across corporate boardrooms, treasury departments, and institutional investment committees worldwide, similar conversations are beginning. The immediate priority for any organization holding precious metal exposure is conducting a comprehensive audit distinguishing between physical and paper positions. This requires examining every metal-related holding with new scrutiny. ETF shares that appeared identical to physical gold now demand investigation of the fund's redemption mechanisms, physical inventory levels, and authorized participant delivery capabilities. Futures positions that served as reliable hedges now require assessment of exchange delivery procedures and registered vault inventory trends. Unallocated accounts that offered convenient liquidity now need evaluation of the custodian bank's fractional reserve ratio and delivery track record. The audit must extend beyond simple categorization. For positions held in segregated allocated storage, verification becomes essential. Does the storage agreement specify particular bars with serial numbers? Does the holder receive regular independent audits of the physical inventory? Can the holder visit the facility and verify the metal's existence? For pooled or unallocated arrangements, the questions become more difficult. What percentage backing does the institution maintain? What delivery rights exist contractually versus practically? What happens during periods of market stress when multiple holders request delivery simultaneously? These are not theoretical concerns anymore. Counterparty due diligence now carries weight it has not required in decades. The financial strength of the custodian bank matters. The regulatory jurisdiction governing the storage facility matters. The political stability of the country where vaults operate matters. A Canadian pension fund holding gold in a London vault faces different risks than the same fund holding gold in a Toronto facility. A mining company with silver futures contracts through a well-capitalized exchange faces different delivery certainty than one using over-the-counter derivatives with a single counterparty. Legal teams are being instructed to review contractual language buried in agreements signed years ago. Force majeure clauses that seemed like standard boilerplate now deserve careful reading. What constitutes an event allowing the counterparty to suspend delivery obligations? Can the custodian substitute cash settlement for physical delivery? What jurisdiction governs disputes over delivery failures? Corporations discovering unfavorable terms face difficult decisions. Some are choosing to exit paper positions entirely, accepting current market prices to eliminate delivery uncertainty. Others are negotiating conversions to allocated storage, paying premiums for delivery certainty. Still, others are diversifying across multiple custodians and jurisdictions to reduce concentration risk. For industries requiring physical metal and manufacturing processes, operational adjustments are becoming urgent. Electronics manufacturers are extending supplier relationships beyond paper futures markets. They are establishing direct relationships with refineries and building physical inventory buffers. The just-in-time supply chain philosophy that minimized working capital is giving way to strategic stockpiling. Jewelry fabricators are renegotiating contracts with suppliers to specify physical delivery terms explicitly rather than assuming paper hedges will convert seamlessly to metal when needed. Aerospace and industrial companies using platinum group metals are conducting similar reviews of procurement strategies. The common thread is recognition that paper price discovery may no longer reliably predict physical acquisition costs. Treasury departments are modifying policies regarding commodity hedging instruments. Risk committees are raising the classification of precious metal exposure from routine portfolio allocation to material strategic concern requiring board-level oversight. Beyond immediate risk mitigation, forward-looking organizations are considering the strategic implications of a permanent two-tier pricing regime. If paper and physical markets remain diverged, the entire architecture of commodity finance requires rethinking. Investment strategies that assumed portfolio diversification through metal ETFs may need restructuring. Reserve management policies that treated gold futures as equivalent to bullion reserves may require revision. Some institutions are exploring alternative reserve assets entirely. Real estate with productive capacity, energy infrastructure, agricultural land, commodities with clearer delivery mechanisms and less fractional reserve leverage. Others are positioning for potential monetary system transitions. If confidence in paper metal claims erodes sufficiently, broader questions about fiat currency stability and central bank credibility may follow. Organizations with this perspective are diversifying beyond traditional financial assets into tangible productive resources. Market observers are attempting to forecast how this situation evolves. One scenario involves regulatory intervention. Authorities could mandate higher physical backing ratios for unallocated accounts. Exchanges could tighten delivery requirements for futures contracts. Government bodies could establish new settlement infrastructure with transparent inventory auditing. Such reforms might restore confidence, but would reduce market liquidity and increase costs. Another scenario involves market-driven restructuring. Paper metal prices could fall further while physical premiums rise until the arbitrage gap becomes wide enough to incentivize new physical supply. Refineries could increase production. Mining companies could accelerate output. Eventually, supply and demand could rebalance at new equilibrium prices. This adjustment might take months or years depending on physical market elasticity. A darker scenario involves cascading delivery defaults, triggering broader financial instability. If major bullion banks or ETF providers cannot meet redemption requests, confidence could collapse rapidly. Derivative positions could unwind chaotically. Counterparty failures could spread through interconnected financial institutions. This path leads to forced cash settlements, legal disputes, and permanent destruction of paper metal market credibility. Decision makers cannot know which scenario will unfold, but they can prepare for any of them. Quantifiable metrics exist to monitor whether the situation is escalating or resolving. The physical paper price spread itself serves as the primary indicator. Widening spreads signal deteriorating confidence. Narrowing spreads suggest stabilization. Delivery timeframes at major vaults provide secondary confirmation. Exchange inventory levels offer additional data points. Organizations should establish threshold triggers. If the price divergence exceeds $25, certain defensive actions activate automatically. If delivery delays extend beyond 60 days, alternative procurement channels engage. If vault inventory falls below critical levels, direct refinery relationships become primary supply sources. Communication protocols matter as well. Boards need regular briefings on metal-related exposures. Stakeholders deserve transparency about potential valuation impacts. Employees in procurement and treasury functions require updated guidance reflecting new market realities. The $16 gap between physical and paper metal represents more than a pricing anomaly. It signals a fundamental breakdown in commodity market structure that has functioned reliably for generations. The distinction between owning metal and owning claims on metal has always existed theoretically. Now it exists practically with a clear price differential quantifying the value of delivery certainty. This development is not reversing through normal market forces. The structural pressures driving it, central bank repatriation, Asian physical demand, regulatory changes, and operational cost increases, are intensifying rather than abating. Organizations that recognize this shift as permanent rather than temporary will position themselves advantageously. Those that continue treating paper claims as equivalent to physical assets will eventually face costly lessons when delivery certainty matters most. The choice facing every financial decision maker is clear: audit metal exposure now, or discover hidden vulnerabilities later under crisis conditions when options are limited and costs are highest. London's delivery problems are not a London problem. They are a preview of what happens when confidence in paper claims meets the immovable reality of physical scarcity. And confidence, once broken, is the most expensive commodity to replace.